Hey guys, in this episode, we'll talk about 5 triggers to make you sell your property. A lot of you are owning multiple, one or more investment properties, or even your own home, maybe. These are some reasons, the 5 reasons where you might think, you know what, right now is actually a really good time to sell my investment property.
Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you.
I want to preface this by saying that selling property in Australia should be a last resort. Of course, I'll talk about 5 reasons why you may consider selling your investment property, but costs to buy and sell, especially stamp duty and capital gains tax, stamp duty on the way in, capital gains tax on the way out, are really high in Australia compared to other places like America. And so that's why in Australia, house prices are generally less volatile because despite what's happening macroeconomically and locally, people always think twice, 3 times, 4 times, 5 times before selling your property and then buying somewhere else. Whereas in America, it's more of a whimsical decision, I would say, because the entry exit, those transaction costs are less cost prohibitive. If you are considering, hey, should I sell my property before buying my next investment property? I would always say, as a general rule of thumb, don't sell unless you have to in order to get into a superior asset. If you still have deposit money left, if you still have borrowing capacity left, maybe it's a good idea to exhaust that before going back to the table and seeing of the assets that you already hold, which ones should you offload for better assets? Because who knows, if you sell, it could take you 6 months to buy again. And in that time, even that property that you thought was a good time to sell 6 months ago could have risen in that 6 months. So you've been left out of the market, missing out on those gains. Anyway, let's go through those 5 triggers. Number 1 is when your property has more than doubled in the last 2 years. There's a lot of people right now sitting on investment properties where they bought them in 2022, even 2023, and they've doubled. They may have more than doubled. There are pockets of Perth, there's pockets of Northern Adelaide where this is actually the case, believe it or not. I know you won't believe me, but even in places like pockets of Elizabeth, parts of Perth, this is around the Rockingham region, this is very much the case. So if it's more than doubled, I'm not just saying close to doubling, but if it's like gone up 2.5, maybe even 3 times in the last 2 or so years, you may consider, look, long-term average house prices in Australia double only, let's say, around 7, 8 years. So you've got that in 2 years. You might have got a tripling effect in just 2 or 3 years. So statistically, chances are that affordability is going to be capped out, for the local population wherever you've bought. And therefore, in the future, house prices in that suburb are unlikely to perform at that same rate. Now, at the end of these 5 reasons, I'm going to share with you what my clients generally do and why they sometimes don't listen to the same advice that I'm giving you, and nor do I sometimes. So it seems counterintuitive why I'm giving it to you, but I think these are bona fide 5 reasons, but you should stick around to the end because there might be a more superior principle for you to consider. Number 2 reason or trigger why you may want to sell your investment property is if in the last 2 years it hasn't actually grown by even 15%, and it's not showing any signs of growth anytime soon. So of course, a lot of people made a lot of money. As always, a lot of people also sitting on dud properties. So you might have bought property in the last 2 years and it's like barely done anything. You might have gone through, some dodgy ad on Facebook that promised the world, but now, you've got a property and it's not even built and it's not going to be built in 2 years, or you've got a property that's just underperforming. It's already established, but it's not doing well. Or you might have something you purchased many years ago, but in the last 2 years, the growth rate has been very subpar, under 15%. Now, that is one reason for you to deeply consider whether you should actually be considering to hold this property. Now, if in the last 2 years your property hasn't performed and you in fact bought it 2 years ago, you have to be asking, like, were you correct in choosing that suburb, that pocket, that street, that particular property? Okay? What made you buy there? And if those reasons that made you buy there are actually in hindsight wrong because it hasn't grown, then you need to invest in understanding real data right now to be able to assess, all right, well, going forward, is it going to grow? Okay, because chances are, if in the last 2 years it's not grown, in the next 2 years, it may not grow either, especially because the last 2 years, I mean, Sydney, Melbourne notwithstanding, much of Australia has performed really well. So you would have had to done really terrible for you not to get any growth or much growth, more than 15% in the last 2 years. So right now you should assess things like days on market, building approvals, the affordability of that location, things like the supply side of story inventory levels, how many months of inventory are in that suburb in terms of houses, and really assess that, okay? Because if you haven't got growth in the last 2 years and you don't know how to assess that, you might just be holding a dud. All right, and that's not obviously a good thing. Number 3 reason or trigger why you should probably sell your investment property is if you've had huge growth. Okay, it's a little bit different. You've had huge growth, but it's been a house and land package. Now, typically, as you guys know, I've done so many videos on this and episodes. House and land packages underperform in the short term, but definitely over the long term. Various reasons for that. I've done a video on YouTube called New versus Old. It's got like 50,000 views. A lot of people saved from a lot of property charlatans and sharks because of that video, hopefully. But I want you to understand this point. In the last 2 years, construction prices went up 30, 40%. There's been a labor shortage. So even though house and land packages underperform over the short term and long term, the last 3, 4 years have been an exception because there's been hardly anything being built. Building approvals down and building completions are down even more. So you've had this amazing growth in your off-the-plan apartment or house and land package and, new areas. Maybe they're around Perth, maybe they're north of Adelaide, maybe they're, somewhere far north of Brisbane, or I'm not going to go on and on. But these guys have poor land to asset ratios, okay? And over the long term, it's buildings that depreciate and land that appreciates. And generally, these are in areas where you've got low land to asset ratio in the property, and in fringe areas of cities where you've got a lot, like literally hundreds, if not thousands of new, and Melbourne's really culpable right now, both in the KC side of things, around Melton, all different parts of Melbourne have a big pipeline of building approvals. Supply is the enemy of future house price growth. So you might have done really well. Well, not in Melbourne. You might have done really well in the last 2, 3 years in terms of your, closed eyes, booked a house and land package somewhere, made a lot of money. But when the market goes back to normality, construction prices stop growing so much, labor shortage abates, the true fundamentals of property investing start once again transpiring and prevailing, then those assets will underperform those that are more established, with a higher land quotient, with all the fundamentals working for them. And so that's one reason, if you've already made 30, 40, 50% growth in these house and land package type areas, you may consider, hey, I've maybe been lucky, all right? Or if your hypothesis is that construction prices will continue to rise, a lot of the building approvals won't get out of the ground because of labor shortages, et cetera, et cetera, et cetera, then once again, you're buying against traditional long-term housing principles, but you may make money. It's not for me to predict that. Things can happen. We may have another COVID. We may have, shipping container costs, freight costs once again go up, which they are. They may continue to go up for years to come with a lot of tension around Iran and trading routes, ship routes. And in that case, even house land packages will probably do pretty well because the housing shortage will get worse and worse and new houses will just not get built in Australia. A glut of supply revealing an oversupply of houses. That may be the case, but you're once again investing against traditional housing principles. Number 4, if the vacancy rate is really high. So you might have a property that's actually ticking along really well. It's growing pretty good, right? But vacancies are really high. And right now we have like the smallest or shortest or shallowest vacancy rate that we've basically ever had in Australia. We've had like this chronic record housing shortage. So right now, if your area has a vacancy rate of above 2.5%, above 3%, maybe even above 4%, and some parts of Western Melbourne are actually in this case, you got to ask yourself, like, all right, maybe it's okay right now. Maybe I'm scraping through, even though I don't have a tenant for weeks, if not 1 or 2 months on end. But when we go back to equilibrium, this place is going to have a vacancy rate of like 6%, 7%. I need to get ahead of that because at that time, everyone's going to sell and house prices may come down a lot. Vacancy is not a good thing because that means you're not getting rent and that thing is costing you tens of thousands to hold, which properties do, generally speaking, in Melbourne and Sydney, which is, again, one reason not to invest in those areas. Generally speaking, there's always markets within markets, especially in Melbourne right now. And number 5 reason or trigger why you should seriously consider selling your investment property is if rents have not kept pace and were low to start with. So let's say you bought a property, I'm just making this up right now, in Sydney, and you've had great growth. Not that Sydney has had great growth in the last 2 years, but let's just go with that, right? But rents have been really poor to start with. Like the average yield in Sydney is like 2.5%. Okay, so it's costing you $30,000-$40,000 a year to hold, and rents haven't risen. Okay, maybe the house price has risen, so you've made money. It's a good job, well done. But rents haven't risen. What you're doing is, yes, you're increasing your net wealth, but you're just digging yourself into a bigger and bigger and bigger hole because as the years progress, that thing is costing you more and more and more money to hold. And there's going to be a point at one point, right? Maybe it's not if you're a high net worth individual, you earn like 500K per annum or whatever. But for the average person, there's going to be a point where you can't hold that thing anymore. It's causing you stress. It's causing you tension. You can't sleep at night because it's costing so much to hold. It's like a liability, right? Maybe consider selling that asset and redeploying that capital, that fund or that money into something that will grow just as fast, if not faster, but actually be almost self-sustaining or actually self-sustaining. So those are the 5 reasons why you should seriously consider selling your investment property. And like I promised at the start, when you buy a high growth, high yield investment property, as I think every investor in Australia should, regardless of whether your income is 80,000, 60,000 a year, or even 400,000, 500,000, you should always go for growth and yield together. It's not even a question whether that trade-off needs to be made or not. Like I think I've demonstrated that over 7+ years of posting 3,000+ deals, right? I think everyone understands that the need for a trade-off between yield and growth is something that only boomer buyers agents are really holding on to. Every person should buy high yield, high growth property. And if you do that, then even if there are times where it corrects, because all properties, they go up, they plateau, there's always a small correction, but that generally pales in insignificance versus the boom that it's just had. Even if some of these factors that I just talked about, these 5 triggers, apply to your property, and they probably shouldn't if you bought, the types of properties you should be buying, high yield, high growth, still you should never sell your property because that's the golden goose, right? Like I've not sold property myself, even though that was my intention at the start. I've managed to pay off my debt using development projects and private equity. But a lot of my clients don't sell their properties for these 5 reasons, and they don't even encounter these 5 reasons most of the time. because that's your golden goose. You want to be holding on to that thing, even if it starts depreciating in value for like 1 or 2 years before the next boom, right? Because that is your golden goose. That is your ticket. That's where your passive income comes from in 10, 20, 30 years time. Trust me, you're not retiring off property in 2, 3 years time. Let me not be that spruiker, right? It takes time. But most times my clients will only sell properties when they're looking to retire debt. Okay, maybe they have 7 properties, they want to sell 3, use those profits, obviously after CGT, to pay off the debt on the 4 that they haven't sold, they don't want to sell, and therefore they've got 4 properties debt-free, and that's their retirement income. That is the reason most of my clients will sell properties, not for any of these other 5, and in fact, they don't actually encounter these other 5 in most instances anyway. So I hope that brought you value. You know, when you watch or listen to an episode like this, hopefully it's actually leaving you with more questions than what you came in with. Because that means you're thinking about it critically. You may think, I missed something or I said something wrong. That's all good, because that means it's actually churning your knowledge base and getting you to think critically. And that critical thinking will serve you and will allow you to consume more strong content and get better as a property investor. These 5 triggers were not exhaustive, but hopefully they brought you value. My name's PK. Thank you for listening. Cheers. Bye.